Happy Monday, Metalheads. Today is July 19th, 2021, and this is Brad with your daily No Bull Precious Metals report. So let's talk about Friday, shall we? I can definitely say I did not see that bloodbath coming. It got uglier than almost anyone expected, and when that dust finally cleared, the entire market was bathed in crimson. All the major equity indices were down almost 1% on the day over day, and even more for the week. The energy sector took a good hit, as did metals, grains, currencies. There was no safe harbor. No one was getting quarter on that one. And some days are just like that. So over the weekend, of course, the internet was ablaze with talk of nefarious plots and schemes. And this was the elaborate move by the big evil banks to flood the silver market with paper to drive down prices so they can buy it up for cheap. I would hope if you're watching this, you know better. It's about the context. In truth, no one except for a few internet enclaves cares enough about silver to even envision a grand conspiracy of that level. Logically, why would a group of entities who measure their value in trillions concern themselves with netting a few millions? It's about looking at things with a big picture perspective. So here's a quick chain of events. We went into the week and month economically soft. We saw this with the continued strength of equities and the depressed 10-year Treasury rate in the face of a greater than 5% inflation in May. The entirety of last week's reports, except for a few regional ones, were not overwhelmingly positive. They paint a very hesitant picture going into the last half of the year. Powell went to Capitol Hill and signaled not only higher than expected inflation, but also an end to the quantitative easing programs. Equities earnings have begun to trickle out, and they are not bright guideposts to a healthy recovery. They're showing that Q2 was okay, but that things are still weak. And then finally, the final nail was that the Consumer Sentiment Index, analysts hoped for an improvement, but instead it remained flat. So by the time the ink was dry on that final number, the sell-off had begun. And that, of course, leads us to today. As I put this together, things are ugly with a capital U. Everything except for a few outliers in bright red territory, which means a greater than 1.25% loss day over day. Not much is actually positive. So although today is still early and the week is long, I can only wonder if we're finally seeing the downturn we've been expecting for months now. Have equities finally had enough and the support is crumbling? Will debt become popular again? It's very hard to say. This week is Housing Week. Today we have the NAHB Home Builders Index that analysts expect to remain steady, but actually came in 1 point lower at 80. The big board is mostly red, and I'll call that bright red. Silver is down. Gold is mostly flat. Retail silver is down, but retail gold is up. On the big FinViz board, we have a mostly red day. In fact, it's a pretty bright red day. Equities are showing bright red. In fact, the Dow Jones is at -2. The S&P is at -1.78. The NASDAQ is at -1.42. And the Russell is at -2.46. Both the Nikkei and the Euro stocks are both down considerably as well. The energy sector is bright red except for natural gas and ethanol. We've got crude that's down over 5%. Brent crude is down almost 5% at 4.7. Gas is down 4.43, and heating oil is down 4.21. Grains are showing pretty red now. Earlier today they were actually green, but now as everything's kind of firing up for the day, we're seeing that these things are turning red as well, or black, with the exception of wheat, which for one reason or another is up. And the metals sector is pretty abysmal as well. We're seeing everything's performing in the red with the exception of gold, although gold is listed as black, but it's actually it's -0.06. Silver is -2. Platinum is -2.43. Copper is -2.65%. And palladium is -0.83. Today's report is the NAHB Home Builders Index. This index is based on a monthly survey of NAHB members designed to take the pulse of the single-family housing market. The survey asks respondents to rate market conditions for the sale of new homes at the present time and in the next 6 months, as well as the traffic of prospective buyers of new homes. The results are then aggregated, adjusted for seasonality, and weighted according to the type of activity. The final number is produced, which falls between 0 and 100, and gauges the relative strength of the housing market, both currently and through the next 6-month forecast period. Given the size of the U.S. housing market, this is an important number. For June, it was 81. Analysts had predicted that it would stay at 81. However, they were wrong. It dropped a point to 80. That's actually a challenge. And one of the reasons for that, provided by the association's chief economist, is that builders are contending with shortages of building materials, buildable lots, and skilled labor, as well as challenging regulatory environment. So this is putting upward pressure on home prices and sidelining many prospective home buyers, even as demand remains strong in a low inventory environment. So the problem that we run into with this, that's a big portion of the economy, is that housing employs a lot of people. It's a huge sector for labor. It's a huge sector for supply, for demand. Think of the effects that it's going to have on copper, including not only, copper wires, copper pipes, copper fittings, everything else that goes into it, as well as you start dealing with lumber, you start dealing with all of the other aspects that surround modern home construction and modern home sales. So this is a pretty big deal, and even a 1-point drop, although anything above 50 is considered to be positive growth. As we start to see declines, because this is a composite number, it's not necessarily just one single aspect. So this is going to have some effects on the economy. Now, moving into the week, tomorrow we have the building permits report and housing starts report. Two more strength indicators for the housing market. So we're going to have to see how those turn out. Like on Thursday night, Friday ended another point down on the 10-year Treasury rate, falling once again to 1.31% with a 4 bip spread on trading. We are definitely heading into dangerous territory. In the silver market, it's been pretty ugly. Around 8:30 a.m. this morning, we bottomed out pretty good. We're down at 2509, and I'm hoping it's a bottom. And that capped a long decline that began on Friday morning around 1 a.m., which was right around here. We saw that take a pretty good hit. So the pressing question is what caused it and where is it going? So causes are finicky to pinpoint most of the time, but in this case there is a direct correlation between the major broad market decline and the release of final economic report last week on consumer sentiment. The numbers just aren't good. There's no positive spin that we can start to throw on this, and we're seeing aspects of the economy that are starting to crack and react to the bad news that just continually comes out. And here's what too many analysts gloss over when discussing silver. It is an industrial metal by a factor of 4 to 1. That means economic data for the manufacturing sector is a critical driver of both current and future price. So hopefully that explains a little bit about my preoccupation with manufacturing reports and why I tend to stress those quite a bit. Now let's factor in one more aspect. The contracts currently being traded are not July contracts. So even on last week, they were not July contracts. They're September contracts. So we are seeing price actions that are based on September delivery, which means we can take much of the movement here as reflective of optimism, of which there isn't a significant amount based off of the numbers that have come out. So we're looking at Q3 and we're seeing these drops and we're seeing the numbers in light of everything. And people are saying, we need to readjust. And especially as we start looking at manufacturing reports, a lot of these that are important for silver are going to be things such as inventories, future orders, production estimates, things of that nature that are all going to factor into how much silver do we need to buy and at what price. And right now, they're not seeing a lot of units being moved, or the entire issue of trying to get units that will move into the consumer market and be able to be produced. So generally at this point, I'm fairly confident we have either already seen bottom or it's in sight. I believe that we've seen where things are priced in. We saw the dip, and now we're starting to see a leveling action. Whether this becomes a new level, it's really hard to say, and it's going to be very market dependent. I expect as the markets move, we'll see silver follow. It'll either lead the pack on the way down or lagging slowly on the way up because, that's what silver does. But at the end of the day, we're just going to have to see. Turning to gold, we have a slightly different situation. This is about where we started on the Thursday downturn, which was July 15th at 23:30, so 11:30 p.m. And we can see where it began the downturn. If we measure it from that point and carry it until the bottom, the movement was similar to silver in a superficial manner, but the numbers were much different. Gold declined from 1828, which was that close late, and when it hit bottom around 8:30 this morning, just need to get there, 8:30, it was 1797.70. That's a $31 decline to be certain, and definitely a break of the 1800 mark. But it quickly recovered, and as we can see, it jumped back up. As I zoom in on this, we can see exactly what that jump looked like. It definitely made that beeline. It was up to 1813. It jumped up again, 1816, and then all the way up. And at 1814, it's healthily in that -2 VWAP range now, which isn't necessarily the perfect place, but it's a lot better than where it was. And given the entirety of the economic movements that have happened or the market movements that have happened, it's not, it could be a lot worse. It's actually into a very healthy territory for where everything is. So we have to keep that in mind and keep that in context. But I think what's interesting is the resilience of gold. And the percentage change is really night and day from silver to gold. Gold has taken a hit, but to quote Monty Python, "'Tis but a flesh wound." The blows have been glancing, and it's actually doing pretty well. On the 5-day performance, silver is obviously in negative territory by a pretty healthy amount. Gold, on the other hand, is really just languishing around that break-even point. Right now, it's 0.03% over on the 5-day. So it is actually in positive territory by 0.03%. But it's not as far down as silver is. Silver went down -3.02. So that's really an interesting kind of a movement. But if we look at the full view of the chart for a second, and just everything that we're going through from the beginning all the way to really this point right here, which was about 10 a.m. on Friday, if we look on the left-hand side of that, we can see that both gold and silver are moving pretty similar to each other. I mean, there are dips, there are spikes. There are certain things that really aren't in perfect alignment, but they're moving together in a very concerted way. You can see how that happens. However, on the right-hand side of that chart, we can see the definite distinction between the two metals and how they reacted to adversity. And whereas gold did not sell off to the extent that silver did, silver really took a dip and continued down further and much more aggressively. But we can still see that there's a superficial notion of certain dips that have occurred, certain aspects where they have moved very similarly to each other. They've kind of risen in certain places correctly, but silver has taken a much more aggressive stance all the way down and gone up. And it's really something that's interesting to see, how adherent both of these metals are to each other, even though that they've really developed a different lifespan for each other. Again, as I've mentioned, silver is a 4-to-1 industrial metal. It's not a monetary or financial metal at this point, primarily. However, gold is. You could almost reverse those two together and see. And it's interesting to see which sectors are taking the hit at this point and which ones are driving declines and growth. The gold silver ratio finally broke 70 to 1. And I don't say that in a happy way. I say that in kind of a downtrodden, wow, this sucks kind of way. This morning it's up, 71.55 to 1. So 71.5 ounces of silver will buy you 1 ounce of gold at market to market. If we shift that over to the retail to retail looking, for one retail ounce of silver to one generic retail ounce of gold, we're almost at the 63 to 1. We're at 62.9. We can definitely see where this all is affecting how both of those metals haven't moved the same and how gold is really outperformed. And that's really what this is a reflective measure of, is that gold is outperforming at this point. On retail silver, we are definitely seeing further price declines. The current week pricing is noticeably lower than previous weeks. However, prices are not falling as quick as they are on the paper market. Over the past month, there's been about a 50-cent drop in the spot retail margin on generic silver. And that's not a huge amount, but it does reflect some comfort in reducing the margins. Can you expect to see some major discount coming soon because of the current paper drop? No. Retailers and distributors have base costs on the items they're selling. So what we're seeing, and the prices that I have outlined within here and within the other charts, are based off of current inventory that exists. It's not on future inventory. It's not on speculative pricing. It's actually on materials that are for sale. So one of the things that we can say is that all of those retailers and distributors have an acquisition cost that are associated with those. Now, if they had purchased those, say, last week up until Friday at really about 10 a.m., we had prices that were well into the 26 range on just generic spot. Now, when you add in the cost of actual manufacturing, refining, distributing, all of that stuff from a wholesaler for the individual 1-ounce rounds or bars or coins or whatever it happens to be, that adds on cost to it. So it means that price is probably, a couple $3 higher. So now if you add on top of that the price that's involved in actually offering that for sale, and at final retail being able to provide cost of goods sold, operating overhead, adding in a little bit of profit, things of that nature, all of a sudden you wind up with that really $30-$31 range that you start to see. That in itself, using just that simple math without digging too far into it, establishes for us a minimum floor. So if you have an acquisition cost that, for sake of argument, we'll say is $26, and all of a sudden you have to add on, we'll say $5 worth of overhead just to make some level of profit on what it is that you're selling in a final sale, that means that your minimum price that you can sell at before you start selling at a loss is $31. Now, if the price declines to a point where it's no longer effective or desirable, or the demand isn't there to be able to sell at $31, what do? Do you take the loss, or do you just not sell it? Do you wait for price to increase? And we can take a page out of the book of last February and March, when all of a sudden there was the major price decline where the paper price went down from, the $18 range down to $11 almost overnight. We saw most of the distributors for quite a while stopped selling. They pulled inventory. And it only makes sense. It's not an instant liquidity market for physical goods. So you have to be able to adjust to that. You have to be able to take things in and be able to sell at a price that makes sense. And if you can't, then it's more profitable not to sell, because you're not selling at a loss. You're not just giving free money away. So with a minor 2-day pullback like this, where we've declined about $1, are we going to be seeing some major sales that are coming out? No, we're not. We're going to see a roughly level type of sale set. And you should expect that. The only place where you're going to start seeing this is going to be limited special sales that you might see that pop up on the big distributor sites. They might have gotten some new inventory cheap. They might be looking to acquire new customers. They might be doing a loss leader, whatever that happens to be. The other place that you'll be seeing it are the desperate, fearful ones, the stackers that see a decline, panic, and decide they want to get out as cheap as possible. Those are going to be your two things, but otherwise, I would say to not expect too much of a difference. And even with the changes that we've seen, just to dig into this chart a bit, is from the pricing. So this is a long form chart. So this is taking 7 days of prices across all of the distributors, and it's averaging them out into 3 distinct groupings. So we have 7 days, 14 days, and 21 days. So this is a windowed long form view. And we can see that over the course of that time, not everything is factored in all the way through because we did have the anomalous price decline. But we do have this first portion, 31.48 was 2 weeks ago, 31.55, so we had a slight increase last week, and then 30.97. So we had, a pretty significant drop, but that's a long form view. Now, if we start looking at this down below, which is a shorter form view, this is more linear. So what we're doing is we're just averaging distributors across each incremental period in time. We're not looking at a windowed view. We're looking at a very, very small window, which is just a snapshot average. The thing that we can see is that although there is a decline, and I'm just going to throw this average up here. So although there is a definite decline that we can see on this line, over the past 5 days, it does not reflect the overall amount that we would be seeing elsewhere. It's something that we are seeing, that general movement, but we're not necessarily seeing the same extent that what we were previously. And I'm just kind of putting this together so that you can kind of see the comparison between highs and lows and everything else. And you can kind of see the disparity between it. But even if we snap back to, say, a market view and look at how silver market was moving, it's similar but not the same. So you're going to see that resistance. You're going to see those limitations and those lower portions. We have had certain low prices that have gotten, 29.34 right now is a low that's currently being seen. However, on the average, we're seeing 30.14, which is about acceptable. It's still within that range. So just something to keep in mind as we start moving forward on these prices. And as you start wondering, hey, where can I get these cheap deals from now that prices declined or whatever? Well, if price keeps on staying where it's at for the next, I'll say, several weeks, you might be able to. But it's going to take an exhaustion of the current inventory in order to really get there. Now, with retail gold, we're still seeing the upward average price. As we start looking from 2 weeks ago to this week, we're seeing an increase across the board. It's not quite as radical as it has been, so we are seeing a little bit of a decline going on, but it's still appreciating. Right now, we don't have any prices on the 1 ouncers that are under 1900. Even the 1 ounce generic, on average, it's 1973 cents. The Kangaroo, 1909. The Krugerrand, 1915. The Philharmonic, 1929. The Maple Leaf, 1934. The Gold Eagle, 1979. And we've got the Gold Buffalo, which is over 2000 in 2023. So in all cases, these prices have gone up quite a bit, and we're still seeing it. So this week will be interesting as we go in and we see how resilient gold actually turns out to be in some of the long run. But this is part of, just kind of circling back, this is part of what goes into that gold silver ratio, especially on the retail side. We're seeing these steady increases in the price of gold on retail, all while spot is not declining that fast on gold, but yet silver is moving quite wild. So we are seeing that widening that occurs. So I don't know if we're at the start of something big or not. When the 2008 crash came, one day things were humming, and the next day Lehman Brothers was being shut down. It happened very quick. I don't know if we're there quite yet, but I'm watching. It's something that as we see the movements within the markets and we see the pricing that keeps occurring, watching a lot of these factors that are aligning and seeing where they're coming into is really the important part. No one's going to be able to predict the moment of the crash, or what's happening, or if there is a crash. What they can do is get a pretty good idea of things that start to align. And part of it is looking at the softening of the various reports, looking at how metals are performing, and especially gold and silver are interesting to me, not necessarily because I like them or anything else, but because they do serve two different functions within the market. It's important to look at those and really start to discern how are they behaving together as well as apart. Where are their similarities as well as their differences? My big thing right now is keeping an eye on gold. It's definitely more resilient these last couple days than I probably would have expected. I'm watching it very close, and I hope that you are too. So with that, I'm going to wrap this up. And remember that likes, shares, and comments help feed the YouTube algorithm and build the audience for true, noble analysis and discussion of the type that you've just experienced. It also makes me happy when I browse my analytics page, and we all like a happy Brad, especially on a Monday when the markets are down. So you can also check out my ebook on silver stacking. If you use coupon code STACKSILVER, you can save 25% off the already bargain basement price of $9.99. And doing so will help me buy coffee. And coffee fuels these reports. So until next time, happy stacking.